Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. Here's your weekly technical analysis of New York and London coffee markets. I'll start with New York coffee. On Wednesday, the 11th of May, the market made a large bullish opening along White Mariposa that closed over both the 50% Fibonacci lines at 217.45 and also the long moving average at the time. This was the start of the recent move higher. Yet this move up was tempered, with prices almost immediately subsiding back below the 50% Fibonacci line and long moving averages. However, the market continues to harry and pressure the upside, enough that on the 17th of May, prices managed to push up not only through the long moving average, currently at 224.35, but also the short medium moving average, currently 224.20. At the time, it was only the congestion at 227.60, 228.40 and 229.15, plus the overhead flatlining medium moving average, currently 228 even, that managed to contain the rise. Then on Wednesday the 26th of May, the market made a further attempt higher, starting with a bullish engulfing pattern leading to a huge bullish long White Mariposa that shot up and closed over all the moving averages bar the medium moving average. This move up converted a head and shoulders top pattern you can see clearly on the daily chart between November 21 and May 22 from a possible head and shoulders top pattern into a head and shoulders continuation pattern. On Friday the 31st of May, prices went further, pushing up and closing over the medium moving average and into a fairly free area that stretched up to at least the April high at 237.70 and eventually 4 weeks ago to the 2012 high at 241.05. It also made the action of 5 weeks ago into a weekly key reversal up. However, as we finished May, the market's rise stumbled at the 2012 high. Yet even then, the market was not finished with the bullish incentive, as though prices dropped back down through all the moving averages. And even with 2 consecutive closes below the medium moving average, we saw a rally up and away from the long moving average, despite penetrating it. 2 weeks ago, and with at the time no closes below it. Yet the subsequent rally was limited at the April high at 237.70, and last week prices turned and fell back down again, this time closing below the long moving average this past Friday. Today we have had a follow-on lower. So where does that leave us now? Well, it would seem as if the prices may now drop down to test the June low so far at 219 even. The support also at 218.05 and the 50% Fibonacci line, the August 21 to February 22 move at 217.45. If these buckle and break, then we could look at the action from late May today as a possible lopsided cat's ears pattern. I'm not altogether happy with this pattern, which is a derivation of the double top pattern, as the right ear is significantly lower than the left. However, this pattern does exist, and it'll be interesting to see how the market deals with this pattern. I'm not comfortable also in placing targets below, not just yet. But to give you an idea, if this pattern does follow through, a primary target would be, well, it would depend whether any target is, because depending on which ear you measure it from. Hence, I will lay out 2 possible targets and will not label either a primary or secondary target. Thus, we have potential targets for this pattern in the 201 even area, as well as the 196 even area. I would add a heavy dose of "it depends" to these potential targets. Now, one final point, and it is on one that needs a lot of pondering upon. It is this: is it just me, or does the action from November 2021 today have elements of a lopsided diamond pattern? Like I said, it requires a lot more pondering. London coffee. The key difference seen here in London compared to the New York contract is how the peak of the market was back in late December 2021 rather than when New York had it, which was in early February 2022. This difference has been crucial to the early formation of a pattern here in the London contract, which much earlier compared to the New York contract. We had a November 2021 to February 2022 head and shoulders top, Admittedly, the first shoulder is split, but the action nevertheless stacks up as a legitimate pattern. The neckline, currently 2109, is super important as it resonated as recently as last week. Going back a bit to March, the market broke down through the neckline but ended up unable to penetrate the support area underneath it. That stretches from the 2004 level all the way down to 1935. In early May, prices made a significant attempt lower, making a new low not seen since August 2021. Yet that achievement should be taken with a pinch of salt, as it was only a little lower compared to the low in early March. Nevertheless, it was worth noting that the primary target for this head and shoulders top had been achieved some while ago, and it was a secondary target, the harder to get secondary target, that was enabled. As I've often pointed out, secondary targets are harder to achieve. The key takeaway from this was not that it had achieved the primary target below, though that was important. It was that the head and shoulders pattern was a topping action, completely different to what we had seen in the New York contract. Since that failed attempt lower back in early May, we have seen the market start to develop not only intraday indecision, such as spinning tops, but also intraday indecision with contrary patterns, one after another. This indecision seemed to have worked itself out by the end of May, what looked like a decent attempt up at the overhead declining short-medium moving average, currently at 2120. And even saw prices approach the now flatlining long-moving average, currently 2169. But then reasserted itself again during June, such that the top side is, more or less, capped by the ever so slowly descending neckline, and supported below by descending levels such as the 50% Fibonacci line of the August to December 21 move at 2064, the September 2017 high at 2038, and the lows of March, April, and May at 2010, 2012, and obviously 2004. Then below all these, we have the previously mentioned support band from 2004 all the way down to 1935. The question now is roughly the same as it has been in recent weeks. Will we see the market higher, or will we continue moving in a rectangle pattern? Fortunately, nothing has happened these past few days that's clarified the picture. Thank you for listening. This weekly broadcast gives essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright Eddie Tofpik and ADM Investor Services International Limited. And here comes the final bit.